When we look at financial ratios and their broader interpretations, some of the questions that would come to our mind is, what do we mean by these ratios? Why do we need these ratios? And in what circumstances do these ratios become really important for us? Right? Now, a ratio is basically a mathematical number. It's a relationship between two numbers. Ideally, you would want to have a relationship that comes from a numerator and a denominator. Now, technically, you would want these to kind of have denominator. Yeah. Technically, you would want these to have some sort of a relationship between each other, because if there is no relationship, then it might just give spurious results. So either the numerator should be driving the denominator or the denominator should be driving the numerator, right? One of these two has to be the driver and the other has to be the variable that gets driven based on a change in the others, and then we can identify the trends. In the context of finance, this assumes paramount importance because it helps us kind of compare elements, right? What do we mean by comparison? Now, how do I compare, let's say, cricket players, right? So if I know that a certain number of centuries has been scored by Sachin Tendulkar in a certain number of matches, then I can figure out, per century how many matches are needed. And then I can compare it to, let's say, a Ponting or a Virat Kohli or someone else, and then make a comparison that, okay, what is the consistency of the player in question? If I just put the absolute number, which is that Sachin Tendulkar has scored 50 centuries in ODI cricket, that may or may not necessarily be the best analysis of the entire equation, right? Because it doesn't give me a sense on what is the value addition the entire thing did. Absolute numbers have that problem. A larger company, for example, in finance, would tend to dominate the ratios when we look at it, right? So if Reliance has sales of 3 lakh crore, then the number itself becomes overwhelming. We can't compare sales of Reliance to sales of, let's say, another company, a smaller company like, let's say, Care in India, for example. But can we compare, okay, how much profit do they generate per rupee of sales with the other company? That we can do. That we can do, right? So what ratios do is they help us analyze quantitative data around any person, business, or entity. In the context of finance, ratios are numbers used to analyze quantitative data, which can be derived from a company's financial statements, derived by dividing one data point from the other. Now, ratios may be financial in nature. We could also have ratios which are business in nature, right? For example, hospitals are evaluated in terms of a metric called profit per bed, right? They have an operating aspect to it, and they kind of admit patients. So typically, what kind of revenue or profit they generate per bed is what is one of the key metrics. I don't get a sense on what is the profit of, let's say, Apollo hospitals versus Fortis, right? Because their size and scale might be different. So if I can get a metric like, okay, what is the number of beds they have and what is the profit per bed they are generating, then I can compare these two and say, okay, who's more profitable or less profitable in these two. So the primary advantage of looking at ratios is that it allows comparison, right? Comparison to what? It allows comparison to other industry players. So in our example, we looked at comparing one company with other hospitals in the same industry. It can be used to compare historical performance of the same company. You can look at numbers starting financial year 2012 all the way up to financial year 2016 and see whether the numbers are improving or not improving, right? And you can use the same ratio to compare with budget or target. Every company has a budgeting process. So at the beginning of the year, they say, okay, this should be my sales and this should be my profit. Does that match, essentially? And if yes, if no, then what are the reasons for those? So ideally, a ratio in itself will not mean too much, but once you compare, once you look at comparison, then it becomes a very, very important yardstick in the context, right? So that's basically where we are looking at in terms of ratios. Now, usually when you look at ratios that are in terms of profits or costs or return on investments, these are expressed as percentage values, while the others are denoted as decimal values. We'll compare this as we go along. So ratios are helping us basically answer questions about financial health of any business. There are some standard ratios which are used worldwide, but ratio analysis is a tool where you can use any two numbers that have a meaningful relationship, and you can create a customized ratio as well. Two things we need to remember. One, the problem with our broader education system is that it touches on the aspect of how do you calculate ratios and how do you observe those ratios, right? Which is you calculate a number and then you see how it is moving. It rarely goes deeper in terms of analysis. At this stage, you may not need it because probably in your subject or in your exams that might not be relevant. But at some stage, this point will become relevant where you move from this to this, because practically calculation and observation are available off the web. You don't need to really use your head too much of that, right? The second point is the definition of a ratio. The definition of a ratio can vary across textbooks, across faculty. So don't worry about that. The key point is you have to use it uniformly, which basically means that if you're using a certain formula for calculating a certain ratio, use that across the sector, use that across the history of the company. Do not go ahead and change the definition for different companies. As long as that is fine, you can use any yardstick or any definition of a ratio. You will get multiple definitions. Just to give you an example, your debt by equity ratio, which is one of the stability ratio that comes in. Some textbooks say you have to take total debt by equity. Some textbooks say you have to take long-term debt by equity. Right now, there's no right or wrong here. You can use either one of those. In the context of exams, please focus on the one that has been taught. But primarily, as long as you're using the same definition across the companies, it shouldn't really matter too much, right? So that's the idea. Those are the two things we need to try and focus on. One is, can we get beyond the calculation and get into some sort of analysis? Two, can the definition vary, and am I comfortable using whatever definitions are there, right? With that in mind, let's start discussing some of the ratios. Now, remember a couple of things. One, we broadly divide ratios into 5 or 6 brackets. This division of ratios in terms of clubbing them may or may not be exactly the same again as per textbooks. It's not the nomenclature that matters, it's the understanding of the ratio that matters most, right? So a company, whether it is profitable or not, is given by profitability ratios. Whether it generates returns for its shareholders and other stakeholders is called as return ratios. Coverage ratio basically tell whether the company is able to meet its obligations in terms of debt and interest. Stability ratio would be an extension of coverage ratio, which is debt by equity. Liquidity ratios are whether the company is solvent, right? So solvency gets tested here. What do we mean by solvency? If today the company has to make some payment, do they have money or do they have assets which can be used to make that payment? And turnover ratios typically give you a detail about efficiency, right? So turnover ratios give you a detail about how efficient a firm is. Broadly, these are the metrics. There are obviously some other ratios that are there. Some are market related ratios. You can always find out a ratio in terms of profit per employee or sales per branch in case of certain other businesses. But broadly, these are the standard financial metrics that come, right? Now let's dig into them one by one. The first one is profitability ratios. When you look at something called as operating profit margin, that's nothing but operating profit that a company generates. Operating profit is total operating revenue minus operating costs, right? Now, Indian textbooks typically say this number is EBITDA. Global textbooks typically say this number is EBIT. Once again, you can use either. It doesn't matter. As long as you're using it consistently, that's fine, right? So operating profit could be EBITDA or EBIT divided by sales. We can calculate both of them, EBITDA margin and EBIT margin, and understand that. Net profit margin is finally how much net profit are you generating for 100 rupees of sales effectively. When you divide net profit by sales, that gives you the number that, how much profits are you generating? 100 rupees of sales per 100 rupees of sales, right? Now we'll try and apply this as we go along on the Excel file and try and calculate it as we go along. So we have data here for Dr. Reddy's labs. and we are looking at the P&L, and we're going to calculate the ratios. So the first term we're going to look at is profitability ratios, and we're going to look at operating profit margin, and we're going to look at net, or let's put this as EBIT margin, and we're going to look at net profit margin, right? This number will be given by EBITDA, earnings before interest, tax, depreciation, and amortization, divided by net sales. Once again, you can use gross sales as well. Gross versus net sales, if you look at the difference, typically some sort of an indirect tax is applied there, right? So once you remove excise duty, you get net sales. We're going to use net sales, right? EBIT margin is EBIT divided by net sales. Net profit margin is net profit divided by net sales. We remember that all the ratios that we calculate for profitability are percentages, right? So how do I calculate EBITDA by net sales? Let's look at whether we have EBITDA numbers available here, right? Now, net profit number is available. That's here, profit for the year, right? So that's in row 40 for this company. Profit for the year is available. So I can straight away go and calculate this number for FY16. Just note the columns carefully. So FY16 net profit divided by the net sales. That's taken care of. I can drag it on the right side. I want to look at this number in terms of percentages. So I go here and convert it to percentages. Let's also increase this a little bit, right? So what we see here is that the company has had margins of around 13 to 14% across the years. Last couple of years were better, but now they have gone down. That's the observation we get, right? So on 100 rupees of sales, the company is making 14 rupees of final profit after tax, right? Now, how do I calculate EBITDA? When we look at EBITDA, you get something like profit before tax, right? When you get a company's exceptional items, you ignore the exceptional items, which means profit before exceptional items and tax is the actual PBT number that we are going to take. Now, if you were to look at PBT plus interest, so let's say I was to add interest to PBT, what do I get? PBIT or EBIT, earnings before interest tax. And to this, if I add the depreciation amount, I should get the EBITDA, correct? So this is the number to which I am going to add first the interest. Where is the interest? Interest is given here. This finance cost here is the interest that the company is paying, right? So if I add the interest cost, that gives me EBIT or PBIT, and I can calculate the EBIT margin, right? So how do I do that? I go here. In 2016, we look at the profit before exceptional items. That's P&L B29 in this case. To this, we add the interest component, close bracket, divided by the net sales number, right? So that's a 20% number, and we can drag it here and we get the data point for this. Similarly, to this number, all I need to do is add the depreciation as well. So I'm going to look at what's the profit before tax plus interest plus depreciation divided by net sales, right? I have not put a bracket here. So let's put a bracket. That's the number we get, 27%. Now let's interpret these numbers. What this means is for rupees 100 of sales, rupees 27 EBITDA is generated. And then out of the 27 EBITDA, you end up paying about 7 rupees or 5 rupees as interest, as depreciation, sorry. And then you get EBIT. From EBIT, you give interest and then you pay taxes, and you arrive at, for every 100 rupees of sales, roughly 14 rupees worth of profitability, right? Now, if you look at the operating numbers of this company, they are fairly stable. That gives us an interpretation that pharmaceutical is a sector where earnings are fairly stable. And the question we need to answer is, how can earnings be so stable? What makes earnings so stable? That gives us an interpretation of two things. One, generally, business is stable. Two, they have pricing power. What does pricing power mean? If input costs go up, if costs go up, your operating margin should go down. But the fact that operating margin remains constant, the fact that operating margin remains constant means that the company is able to pass on a rise in the input cost to the end customer. Correct? If my cost goes up, but I'm not able to price it accordingly in the market, then my margins will decline. But if I am able to pass on a cost movement, then my margins will be stable. So it generally indicates that one, the business is extremely stable. Second, there is a lot of pricing power that these companies exhibit, right? Those are my profitability ratios. That's the broader interpretation. The question we need to try and answer if we see a trend going up or going down is, why is a certain ratio going up or going down, or why is it stable? It's stable because they exhibit pricing power and because the business is generally stable on these companies, right? That's our profitability ratios for Dr. Reddy's. Let's move ahead and look at return ratios. So what do we mean by return ratios? Return ratios is someone has given us money and we have generated a return. So return generated on that money, on this money. That's my return ratio, right? So who has given us money? Typically, either the shareholder guys have given us money or we have received money from loans. So there are two broad ratios. The first one is called return on net worth, also known as return on equity, which is your net profit divided by your equity value, which is share capital plus reserves and surplus, right? The other one could be return on capital employed. Now, again, textbooks differ in terms of the definition that comes out, and we can understand that as we go along. Some textbooks say return on capital employed is EBIT into 1 minus the tax. You want to remove the taxation component from it, divided by total assets. Total assets should be equal to total liabilities. Total liabilities are all the guys who have given you the money, right? Some textbooks also give return on capital employed as EBIT divided by equity, shareholder funds, plus debt, loans, because those are the guys who have given you the money. You can use either definition once again. As long as you're using it uniformly and consistently, that should be broadly fine in the real world, right? Remember that if you take EBIT or if you take EBIT minus EBIT into 1 minus tax, as long as you are comparing it for the same sector, the tax should be uniform. If the tax rate is uniform, whether you use EBIT in the numerator or whether you use EBIT into 1 minus 30% in the numerator, you will get the same ratios. The trend in the ratios will remain the same, correct? So it doesn't matter whether you use EBIT or EBIT into 1 minus T. E plus D, shareholder fund plus loans, is in a way going to be your primary driver of total assets. You could use any of these. What does this mean? Every company, once they make money during the year, they have the option of returning that money to the shareholders and loan guys, right? You can pay interest, you can pay dividends, you can repay the loans, or you can choose to reinvest the entire money, right? If you reinvest, you need to generate returns, right? If a company is showing, let's say I am an investor in Dr. Reddy's and return on net worth I expect is 15%, which is if I put my money in Dr. Reddy's, I want a 15% return as equity holder. If I'm not getting 15% as the equity holder, I will be a little bit worried about it. I will probably try and take my money out and go to another company that gives me 15%. So it is important for a good company to ensure that if they want good reinvestment, which is if they want shareholders to keep giving money to the company over a period of time, then they need to generate returns on the money that is being put back into the company, right? Money is being put back either in the form of reserves and surplus or in the form of loans. So we are trying to capture these two. Let's do this calculation on the Excel. So we go to return ratios and we're going to calculate both of the numbers here. So return ratios, return on equity, return on capital employed, right? And I'm going to do another return on capital employed. This is net profit divided by equity value, or what we call as shareholder funds, right? If you look at the balance sheet, your shareholder funds would be share capital plus reserves and surplus, these two numbers put together, right? So we are looking at that as we go along. And when you look at this could either be EBIT divided by shareholder funds plus loans, borrowings, or it could be EBIT into 1 minus T. As I said, we can use either formula, divided by total assets, because total assets is the same as total liabilities, right? So net profit by shareholder funds, where's my net profit? It's in the last row here, 2151, divided by, I open a bracket because I need to add these two numbers, 85 plus 11616, right? 18%. If the company is not giving at least 15 to 12%, 15 to 20% kind of a number, we wouldn't be happy about it. Now, note what happens is the return on equity is declining, right? Why is it declining? So we will arrive at this calculation at some point of time as to why is the return on equity declining. Why declining, right? We see that we've calculated it. We have observed that it is declining. But the question we need to answer is, what is the reason behind this decline? And that might be an interesting answer as we go along trying to evaluate this company. Similarly, return on capital employed, what is the EBIT? Remember, our EBIT formula was profit before tax and exceptional items plus the interest component divided by, now this shareholder funds, share capital plus reserves plus long-term borrowings. And again, you can either use long-term borrowings and short-term borrowings, but ideally we use only long-term borrowings here if we are using equity plus debt, because short-term is more working capital oriented in nature. So typically short-term borrowings don't really come in with the perspective of generating significant amount of returns over the longer run. So I'm going to use only long-term loans, and I'm going to write it here in terms of long-term loans that are being used, right? So that number obviously is higher. Again, that number has seen the same declining trend that we were seeing in the context of the return on equity, right? Finally, we calculate EBIT, which is 3137 plus 82. Multiply this with 1 minus 30%. I'm just using 30% as a broad number because that will make things simpler for us. And divide this number by the total assets number. Right, so I can take the total assets number and divide it. And we get a certain calculation here. You will note that the trend is what is important, and I am bothered about the trend. The trend is declining from 13 to 11%. Here the trend seems to be declining from 31 to 25. You can use either of the numbers in terms of your calculations. Obviously, because we have used a 1 minus T factor here, this return on capital employed will become lower than this return on capital employed, right? The industry typically ends up using this definition. Typically, the industry uses this definition, but you could choose to use this definition as well. So what do we observe? We observe a decline, and the question in our mind is, why is the decline? Why declining? Right? So that's the question in our mind. We don't have an answer to that as of now. We will try and arrive at that answer using something more interesting as we go along doing the ratio analysis for this, right? So far so good. So we get the context of return ratios as well. Let's move ahead and look at this number called coverage ratios. So what is a coverage ratio? So what do we mean by a coverage ratio? When we look at a coverage ratio, when we are building a P&L, usually you have EBIT, then you have interest, then you have earnings before tax, then you have tax, and then you have your final net profit, correct? Now, if someone was to figure out, the banker is typically bothered about this number. Why? Is because the banker's money, which is the interest, is going to come from that number. So if I were to calculate a ratio on how much my profit before interest covers my interest, how much my profit before interest covers my interest, that number is called as coverage ratio. Now this is an important number to calculate for every company. Why is this important for calculation for every company? Is because if the number is high, then your EBIT is significantly higher than your interest. If the number is low, there is trouble. So what happens if the number is less than 1? That means your EBIT is lesser than your interest, which basically means you are in default territory at this point. You cannot pay your interest with the profits you're making, right? If EBIT is just slightly greater than interest, then you will see a number which could be possibly around 1.5, right? Let's take the example of a company who has sales of 100, costs of, let's say, 900. That gives me an EBIT, and I'm assuming depreciation in the cost, EBIT of 100. Let's assume the interest is somewhere around 80. What is the ratio? 100 by 80. That gives me 1.25. It seems the interest is adequately covering, the EBIT is adequately covering the interest. But imagine if the sales of this company go down by 3%, right? Just nothing happens. Just the selling price of the good goes down by 3%. So you have 970, 900, cost doesn't change, 70 and 80. And suddenly you are in default territory. So a number, if this number is between 1 to 1.5, so this is less than 1, this number is 1 to 1.5, if your EBIT is greater than interest, which means the number is between 1.5 to 3, you still have to be cautious on the company. And if the EBIT is significantly large than the interest, which means the number is greater than 3, then everything is fine with the company. Usually those are the thumb rules you follow. Interest coverage ratio of greater than 3 is absolutely fine. Interest coverage ratio of less than 1 is default. Anything between 1 to 1.5 is trouble, because the company doesn't need too much of dip in sales for it to kind of get into negative territory. And anything between 1.5 to 3 is usually, as a thumb rule, considered cautious, right? So let's calculate the interest coverage ratio and interest coverage ratio. This is nothing but EBIT divided by the interest. And how do I find it? What is my EBIT? EBIT is again the sum of profit before exceptional items and tax plus the interest, and divide this number by the interest, right? So this company seems to be remarkably comfortable in the context of what they are doing. There is no real problem as such when you look at this company. Any number above 3 is good. They are above 20 almost all points of time. And you see it increasing from 19 to 39, which basically means two things. Either the interest cost is falling, which is evident here. 106 becomes 82 over the years from FY12 to FY16. Also pertaining to the fact that probably debt should be going down. So 1600 going down to 1069, right? So it basically gives us an indication that interest rates are kind of, the loans that the company hold are going down, right? That's basically what we are looking at when we look at this calculation of interest coverage. So that's broadly about the interest coverage ratio. It's an important number because a lot of the times we focus a lot more on the following ratio that we are going to look at, which is the debt equity ratio. But it's important to figure out, whether the company is able to kind of tackle whatever interest they have, right? Next, we move on to something called as the stability or debt equity ratio, which could be long-term debt by equity or total debt by equity. Either one of these formulae are fine. When you look at debt equity, there is generally textbooks say 1:1 is good, or 2:1 is good, kind of a number, but it depends more on what industry you are in. And any number is good as long as your interest coverage is good. As long as your interest coverage is manageable, as long as you can manage your interest coverage, then whatever number of debt is there is immaterial, right? So it could be 3:1 for all we know. If as long as you can make enough money to pay off the interest, that's fine. Usually what you see is once it crosses 1:1, 1.5:1, then it starts becoming a little bit tricky, right? So let's try and calculate the debt equity ratio. And we'll calculate both of the numbers here. So I'm going to calculate long-term debt by equity, and I'm going to calculate total debt by equity. And let's look at those trends as we go along, right? So when I look at the long-term debt divided by equity, that's 85 plus 11,616. And when I look at total debt, that's going to be long-term borrowings plus short-term borrowings, which is this 2272, divided by my 85, which is share capital, plus 11,616, which is reserves and surplus, total equity value. That's the number we are looking at. Remember, debt equity has to be put in the context of decimals. We don't really look at it in the context of percentages, right? So only return ratios and profitability ratios is what we look at percentage wise, right? So this number we have seen was improving. Reduction in long-term debt probably is the reason. And here, long-term debt surely headed down. The short-term debt, when you combine, is also kind of, total debt is also headed down. So they used to be at something like 0.65, has gone down to 0.29. It seems the company is repaying debt, right? It seems the company is repaying debt. Good or bad, we could debate that separately, but it seems that the company is kind of repaying debt, and they might have their own reasons for doing it, right? So that's my coverage ratio, that's my debt equity ratio. Next, we move on to liquidity ratios, which is current ratio and quick ratio. Current ratio is nothing but current assets by current liabilities. Basically tells you whether you have enough current assets to cover all your current liabilities, right? Quick ratio is one step ahead. It's a slightly more stringent format. So what are the major current assets? Major current assets are cash, receivables, inventory, some sort of loans and advances that you've given. Once you remove inventory from these major current assets, what is easily recoverable? What is easily recoverable is cash and receivables. So quick ratio typically is cash plus receivables divided by current liabilities, right? You also have a cash ratio, which is cash by current liabilities. So let's calculate the solvency or liquidity ratios. We're going to look at current ratio. We're going to look at quick ratio. Current ratio is current assets divided by current liabilities. And this is going to be, I'm just using cash plus receivables. You could also do current assets minus inventory, in which case you include the other assets, but you ignore the inventory there, right? I'm just using cash and receivables here. That formula is also fine. So if I do a current assets by current liabilities, what are my current assets? That's the sum of these five, right? So let's actually do the sum of these five divided by the sum of current liabilities, correct? And that gives me 1.72. And what is cash plus receivables? I can go on the balance sheet and look at what is the cash number in current assets. So the cash number looks like cash and bank balances plus trade receivables. In general, in practical sense, what you see here as current investments, these numbers here in the form of current investments, are also cash equivalents. The company basically has just put those in terms of some sort of a mutual fund or investment. So I'm going to use that as well because that is cash equivalent, and divide this by the sum of all current liabilities. Right, so we have a number which is 1.73 on current ratio. It seems the company has adequate current assets to cover its current liabilities. It seems the company has adequate cash and receivables also to cover its current liabilities. That number was lower but has improved in the context of the way solvency ratios are looked at, right? Now, this is a tricky ratio to understand in itself because textbooks suggest that a higher number is better. Real life may suggest otherwise. The discourse on why current ratio being lower may also be good, is something that we cannot discuss today here, but at times companies show lower current ratios and still look to be fine, right? Here it assumes that it appears that the company seems to be generating enough current assets to be able to take care of the current liabilities that they have, right? Let's finally go to the turnover ratios. Now, generally, again, turnover ratios, historically, there have been two kinds of textbook numbers that come out. So, for example, when you look at something like inventory, it's also given in some textbooks as cost of goods sold by inventory. Now, in real life, if you're outside the company, the COGS number doesn't appear. You don't have this number, right? Cost of goods sold is a combination of raw material cost plus whatever labor went in producing something, whatever specific distribution charges applied to a particular product. Those are not available to an outsider. Only if you're in a company's finance team will you have that data. In the absence of that, you just rely on sales by inventory. You can also use average numbers, average sales by average inventory over the year. I'm just removing the average concept here just to kind of quickly calculate it. Remember, any turnover ratio, X turnover ratio, turnover is sales, is nothing but sales by X. So inventory is sales by inventory, receivables is sales by accounts receivable, asset turnover is sales by total assets, fixed asset turnover is sales by fixed assets, right? Let's calculate all these. So we look at turnover ratios, we will look at inventory turnover ratio. Let's copy this bit. We will look at receivables. Turnover ratio. We will look at total asset turnover ratio, and we will look at fixed asset turnover ratio, right? And everything is sales by inventory, receivables by inventory, total assets by, receivables by sales. My mistake. And again, my mistake. Sales by receivables. I calculated the other way around. Sales by total assets and sales by fixed assets. Correct? So basically that's what we are looking at in terms of the turnover ratios. And let's calculate these. So sales, we'll look at net sales everywhere. So we're going to take net sales divided by inventory. Inventory is here. That's 1. Then we're going to look at net sales divided by receivables. That's here. We're going to look at net sales divided by total assets. That's available here. And we're going to look at net sales divided by fixed assets. Fixed assets is the sum of these tangible and intangible assets. So we're going to probably look at sum of tangible, intangible assets and capital work in progress, and that comes as this number, right? Now let's interpret this. Let's first drag it on this side. What we understand is that inventory turnover ratio has gone up, which basically means now they are turning their inventory almost 6 times during the year, as against roughly 5 times 5 years ago. That's a good sign. Why is that a good sign? Because higher turns mean lower inventory per rupee of sales. Correct? So that's basically what they are doing. Receivables, extremely stable, which means they have a certain cycle of payment collection, and they are fairly stable around that over a 5-year period, give or take a few points here or there, right? Then you have total asset turnover ratio. That's gone down a little bit. What does that mean? They're getting a little bit less efficient. Right here also they're getting a little bit less efficient. For the same amount of assets, they are generating lesser sales, or for the same amount of sales, their assets have increased a little bit, right? Now this could possibly be because you've just added capacity, so your fixed assets have gone up. Your denominator has gone up because you've just probably added capacity, right? So I can say probably done some capex, and because of that, what's happened is fixed assets have gone up, but so far it has not been fruitful in terms of what sales are generated out of it, right? You saw 2.29 went up to 2.47, 2.48, 2.49. This was extremely stable here. Suddenly, fixed assets went up. So either of two things have happened. Either sales have gone down, that has not happened, or in the final this thing, when you're looking at the fixed assets number, that's gone up, right? So it means they have added capacity, but the sales have so far not gone up in the same proportion, which might follow. It may not be such a bad problem to have at this point of time. Inventory wise, their efficiency is significantly better, right? That's broadly the ratios we have calculated. Now, there's one number that we have not yet finally understood as to why is return on equity going down, right? And we've also not really been able to find out why debt equity is going down. So is there a policy? We need to probably look at company documents to understand it better, whether they want to kind of move towards zero debt. Is that their idea as to why they are repaying debt, or this is just a transient phase where they probably did not have enough projects at this point of time, but as soon as projects come up, they will raise more debt as it goes along, right? So that bit we will have to kind of capture and understand in terms of what the company is doing in terms of debt equity. It's surely going down, but is that a sustainable measure that the company has, or is that just a transient phase? For this, you will have to read a little bit of the company news, company documentation, maybe the annual reports of the companies, which might give this data as to why is debt going down, right? The one number we have not been able to identify and answer is the return on equity number. Why is this number going down, right? Now, how do we calculate return on equity? So to understand this return on equity number, let's go back to our return on equity slide. To understand return on equity better, note that this is net profit by total equity value. Correct? That's what my ROE is. Now there is an analysis which basically allows you to just multiply this with sales by sales. And there is an analysis which will multiply this by assets by assets. I can do this. Nothing wrong with this. Mathematically, I can just multiply the numerator and denominator by sales and then numerator and denominator by assets. I'm multiplying by 1. Correct? Now I rearrange this. So how do I rearrange? I do net profit by sales multiplied by sales upon assets multiplied by assets upon equity. I can do this. I can do this, right? This number is my net profit margin, net profit by sales. This number is my total asset turnover ratio, right? Total asset turnover ratio. This number is total assets by equity value, right? So when I look at total assets by equity, in a way, my total assets will be equity plus debt plus other liabilities divided by equity, right? If I for a minute assume that the company has no other liabilities, then this number becomes equity plus debt by equity, which nothing but translates into 1 plus debt by equity, right? Now, in a way, this number of assets by equity will be driven by your debt equity ratio. If you increase your debt equity ratio, this number will go up. If you decrease your debt equity ratio, this number will go down, right? Let's try and look at this. This analysis is called as the DuPont analysis, where return on equity is divided into net profit margin, total asset turnover, and what is called as a leverage factor, right? Leverage factor. The first number shows increasing profitability. An increase in this means increasing profitability. The second number shows an increase here would show better efficiency. So this is profitability. This is efficiency. The third number shows optimal capital structure. So if a company has zero debt, and starts raising debt, till a point, this will be useful, right? Any increase would indicate asset increases relative to equity, which would have happened due to bigger loans. As you start taking some debt, that is usually useful. Why is it useful? Is because cost of debt is less than cost of equity. You will learn about it as you go along, that debt is cheaper than equity, right? Because debt is cheaper than equity, as you start raising some debt, that's useful, right? However, over a period of time, if you keep raising debt after debt after debt, at some stage your company will become unstable, right? Now, what is absolutely imperative or important when you look at this number is if ROE is going up, is it going up because of net profit margin going up? Is it going up because of total asset turnover going up, or going up because of leverage going up? The first two are straightforward. If it is profitability improvement or total asset turnover improvement, that's great, right? The third is not so clear. For example, a company could take lot of debt, invest in marketing, increase sales, right? So let's say a company has sales of 100, profits of 10, and equity of 100, right? This is equity, this is sales, this is net profit. Now, a company takes a lot of debt, somehow sales go to 150, but profits only go up to 11. Sales increase by 50%, profits increase by 10%, right? But equity is still 100. So if you calculate ROE, ROE would be 10% here, but 11% here. ROE has increased, but it may not be a great idea because that's increasing courtesy this third parameter. Because you have taken a lot of debt, assets by equity has gone up, and that may not necessarily be good in the long run. So it is important to find out why is the movement in ROE happening, and is that necessarily bad, right? So let's try and calculate these three numbers. When we go to our Excel file, let's put up the DuPont analysis. So what do we need? We need net profit margin. We need the net profit margin, that's here. We need total asset turnover, that's here. And we need the leverage factor, right, which is assets by equity, right? And this is sales by total assets. Here I will put it as total assets by equity, and net profit margin is straightforward. That's my net profit by net sales, right? Let's calculate the first one. That's available, 14%. Let's link the second one, that's available, 0.77. Let's calculate the third one, total assets by equity. So my balance sheet, total assets divided by the sum of 85 plus 11,616, correct? That's 1.71. I can calculate the ROE by using a product of these three, multiplying these three numbers and looking at it in a form of a percentage. These two numbers I'm going to look at in the form of this. Let's drag it further ahead. You will note that your ROE numbers, which are 18.4, 23.7, are exactly the same as these ROE numbers here. I can copy this and paste it as values here and paste it as formats here. We will see that the return on equity calculated earlier is this, right? Now, let's try and identify why is this declining. And I think this has changed. Let's convert it to this. Why is this declining, right? Is there a decline in the net profit margin? No, that's steady. That was 13.8% in 2012. It's 14%. So profitability is actually steady. It's marginally improved a bit, right? There is a little decline in the total asset turnover, and that's possibly because they've added capacity. It was kind of stable for the first 3 years, but then fallen a little bit in the last couple of years. It seems they have added some assets in terms of capacity, right? Looks like capex, so that's fine. It probably driven by capital expenditure, so not too bad. There is a big decline, 2.27 becoming 1.71, right? Now this is probably happening because debt is going down. And now if debt is going down and that is causing your return on equity to go down, is that necessarily bad? Is that necessarily bad? It may not be so bad. So this decline may not be bad because debt decline is causing it, The decline may not be bad because debt decline is causing it, right? And that's basically what the ROE is going to tell us about. That's basically what the DuPont analysis tells us about. That where is it that you are getting this calculation from? Where is it that ROE is going up or ROE is going down? It is not necessary that an increasing ROE is always good. That could be happening because the company is taking a lot of debt. It is also not necessary that a decreasing ROE is always bad, because that could be happening because the company is reducing the debt number, as we saw in this particular case. The other two elements were not moving too much, right? That's basically it in terms of DuPont analysis, and that's broadly what we wanted to cover in this particular